Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome to the Private Practice Survival Guide podcast. Welcome back. Thank you for joining us for this episode. Today, we are delving into your profit and loss statement. We're going to break it down. We're going to dissect it. We're going to turn it upside down, turn it sideways, spit it out, eat it up, spit it out again. I know, you're probably like, holy cannoli, what did I get myself into? But I promise you that this episode is going to help you understand why we look at a profit and loss statement, the way to look at a profit and loss statement, how to strategize, when to strategize, the way that we utilize it, and then even how we create micro profit and loss statements, the way that we formulate this as a function of our business. Because here's the deal. We're a vehicle of change, as I've shared with you. We cannot get to our destination without one thing: fuel. The profit and loss statement is how we measure your fuel. If tomorrow I took away that little thing that said empty, halfway, or full, you'd be in trouble. You wouldn't know when gas is out. You'd have to look at things, but chances are, more often than not, you'd either run out of gas or you'd be less efficient because you'd always be filling up. And so by measuring your profit and loss, we're able to do something about it. And the purpose of our business, now some of you may disagree with this, the purpose of our business is not to make money. Does that surprise you? Probably. And you're probably like, I disagree with that perspective, Brandon. The purpose of my business, I need to make money. I didn't say you didn't need to make money. I said the purpose is not to make money. The purpose is to create a desired outcome on behalf of someone else. Think about any business. Think about, I just had a rental car with Alamo. Alamo's job, they do the same thing as all the other rental cars, but their goal is to create a desired outcome for me. And what am I looking for? I'm looking for value. I'm looking for a clean ride. I'm looking for newer cars. I'm looking for easy access, all these things. That's my desired outcome. So they want me as a client, they want to create that desired outcome. In order for them to create that desired outcome, they make money. They need to have money. They need to keep money. It's got to be worth their time. So the purpose of your business might not be to make money. It needs to make money, unless you're a nonprofit, but even that needs to make money. Everything in life, money makes the world go round, plain and simple. So as we look at our profit and loss statement, we're going to not just evaluate how much revenue comes in, but we're going to look at every little bucket of where that revenue goes. And so you're going to see very clearly that this game is a game of chess. How many moves do we need to make to secure the queen? Our profit is the queen. We need to secure it. So, first and foremost, I want you to craft an expense analysis. Are you ready for the expense analysis? I want you to collect all expense data. That is, software solutions are available for this, but that's everything. Sometimes you use QuickBooks, sometimes there's AI, there's companies out there. I'll give one shout out, and that is for a company called Accounted For. Accounted For has a way that they capture the data specifically from QuickBooks and other accounting software, and they make the expense data like kindergarten ready for you, and then they coach you on it. And I bring them up only because that is something that will help you collect your expense data. Once you have that data, all that data, every single expense down to the socks you buy for your employees, then I want you to categorize that expense. And when you categorize it, you're going to categorize it in two different ways. One is, I want you to categorize it through the lens of fixed expenses versus variable expenses versus discretionary expenses. Again, fixed expenses. Every month I've got rent, that's a fixed expense. Variable expense. Well, depending on how many services we do, our total people expense goes up and down. How many days they are, that's a variable expense. An EMR could be a variable expense if you're paying per visit or you're paying per employee, etc. Discretionary expense, that's an expense you choose, maybe going to the convention this year for your association is a discretionary expense. So again, we've got our categories: fixed, variable, discretionary. But then we're going to categorize it on another level. We're going to put it into a total people expense bucket. That is going to be every single penny that is impacted by your people. If the expense goes up or down based on people, it is a people expense. Wages go up or down based on how many people. Taxes go up or down based on people. Work comp goes up or down based on people. All these things are impacted by people. Other expenses that you may not be thinking about: mileage reimbursement, benefits, liability insurance, computer, EHR, if you give them an email address, if you give them a computer, if you give them a Canva account, I don't care. Anything that goes up or down based on the quantifiable amount of people is a people expense that they directly need in order to facilitate their job. Total facility expense. So our total facility expense is anything that keeps the lights on, that is, cleaning the office, that is power, electricity, utilities, water, cleaning the snow off the ground, all that stuff, parking lot repavement, all of that is under our total facility expense. Then we've got our marketing expense. That's going to be like marketing. And then we usually have a miscellaneous category, professional expenses like lawyers, CPAs, and some little things will fall into that. Testing equipment for patient care usually will fall under people because the people need the tools in order to execute. Phone systems, depending, could be a facility, or sometimes it's a people expense. If you're like, I'm giving everyone a Google Voice, then I would categorize that as a people expense. So those are the things to think about. Next thing I want you to do, I want you to measure each expense in ratio to the following. Are you ready? I'll say it twice because I know this is important. All of those expenses, you're going to measure it in ratio. What is ratio? Percentage. And you're going to take it in ratio to that. So you're going to get the dollar amount of total facility cost to revenue, total facility expense to what it costs per appointment, what it costs per service, what it costs per time. So I'm going to get a percentage of revenue, and I'm going to also get a dollar amount per appointment, per service, per increment. So, example, my total people expense is 60% of my revenue. I average $86.36 in total people expense per appointment. I average $96.36 per hour. And they could be different because some appointments are longer, shorter, and it's an average. It might be that I average $265 per evaluation and $161 per service offering, depending on what that is. These are all the things we're measuring those expenses in ratio to. Again, I want to know your total people expense ratio to revenue, appointment, service, and time, total facility expense, marketing expense, technology expense. All these things are so critical because this is how we think with things. Now, if I went to you and said, hey, you get $110 in revenue for every hour of delivery, but you're spending $104 per every hour of revenue, generated in people expense. That's pretty critical. You better be ready to rumble because that's going to take some recalibration. Now, we've collected our expenses. We've categorized our expenses. We've measured them in ratio to what? 4 things: revenue, calculating it by appointment, service, and increment, time increment. So if you do 30 minutes, 60 minutes, etc. Because some of you are doing all different. You got 15-minute appointments, 30-minute appointments, 60-minute appointments. These are all things we got to be ready for. Next thing I want you to do in this expense analysis is I want you to take those expenses and I want you to compare them to your budget. Did you create a budget? See, here's the deal. When I audit people's financial wellness, that's what I call it. We go in, we look at your practice, we look at like how you're operating. We look at the financial function. Most companies, when I say, show me your budget, they're like, what? I just kind of like loosely have this thing. I'm like, no, we're going to have episodes on budgeting. But here's the thing. 2024's expense analysis should be the starting point of your budget in which you say, are my expenses going to go up or go down based on what I'm trying to achieve this year? And you create line items for all of those things. We want to measure, are we overachieving, underachieving budget? And are we getting the same return on investment for each expense? So every expense that you look at, I want you to ask yourself, is this a revenue generating expense? So cleaning the office, does that generate revenue? No, that's a qualitative expense, but it does not generate revenue. It's not quantifiable. Now, would you lose money if you didn't have a clean office? Yes, but again, that's qualitative. But another expense may be an evaluation tool. Well, that might be a revenue generating expense because now I can perform a specific evaluation that gets a specific revenue source. That could be that. EMR, I believe it's a revenue generating expense. I believe that I can budget $4 for every single appointment if I have the right EMR. $4, because it's going to save me so much time. That is the goal. So imagine if you could save $185,000 every year in labor simply because of your EHR. Which EHR? You're always going to pay something. So it's so funny because I run into these practices and they pick the cheapest EHR. And I'm going to pick on Practice Fusion, the medical doctor, because there's a couple different EMRs. I remember when Practice Fusion was free and I'd go into a physician's office and the physician would say, I'm like, what EHR do you use? And they would say, Practice Fusion. And I would say, why? They say, because it was free. And then when Practice Fusion started charging, they're like, now I got to go shopping. I'm like, yeah, but you get what you pay for. So I'll leave it at that without knocking them. They've improved their software dramatically. Why did they improve their software dramatically? Because now they're actually collecting money. They're actually charging for it. So I'm a big believer that just because something's free does not mean it's for me. So I really believe that we need to budget for revenue generating expenses that streamline the way that we do things, that make things efficient. So once we're done with our budget, I want you to calculate your key metrics. What are those metrics? What are the things that drive that expense? How many visits do I need to justify the facility expense? So I need 1,000 appointments a month for me to be on target with the ratio of my total facility expense to my revenue. Okay, I'm there. Now I know what my KPI is. Now I know I need this many visits and appointments for this square footage. You want to come on board? You want to make this much? This is your KPI for you to afford that expense. I want you to recognize that the ratio of revenue to expense is how much affordability we can justify in correlation to your business algorithm. So we've calculated our key metrics. What's next? ROI, return on investment. I want you to evaluate each category. I want you to look at the revenue generating benefit and the return on investment. So I'm going to give you an expense right now that I think is pretty controversial. And some of you will tell me that maybe I'm the epitome of the demise of quality of healthcare because of this. Are you ready? I'm calling myself out, and I would challenge you with my perspective, but I'm okay to be the idiot wrong. I believe that we waste more money on garbage receptionists, and we should destroy the entire function of a receptionist. And I think we should elevate what that role looks like, and we should solve the budgetary affordability by automating more so we no longer have live answer reception. I would rather I only speak with a person when it is a qualitative communication that generates more revenue. And answering the phone and answering questions can be solved, in my opinion, with AI, with proper channels, with texting, with all these different solutions. Imagine if you never spoke to someone again for scheduling. I think all scheduling should be on your telephone, all app-based, everything. I've been able to cut $280,000 of revenue with technology. And I know that you can do it. And you know what's funny? All of my patients now love it. The problem is that, and this is a generality, receptionists love to create relationships with patients. They don't want to be the bad guy. They want to be the customer service. The reality is there's not enough margin in that game. And basically we're creating a funnel where we're paying for conversation. We lose more money in conversation every day than any other expense line. As simple as this. You answer the phone and it's literally like, thanks for calling Wellness Works Management Partners. This is Brandon. How may I help you today? Yes, I had a question, blah, 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 blah. This is about, oh, nice to meet you. I loved seeing Jimmy yesterday. I can't wait for this. And the conversation goes through over and over and over again. And even today, someone left me a voicemail. And they said, I have a question for you. And I said, I cannot call you back. Can you please email me the question? They emailed me the question and it was solved right away. If I was on the phone with them, they would have said, while I have you, blah, 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 blah. Unless we're doing coaching, unless we're doing clinical care, unless we're doing something of revenue generating value, let's streamline the way that communication is delivered. Let's optimize the output and the input, because I can pay a concierge more than I can pay someone who just answers the phone and says, thank you for calling. How may I direct your call? And you can get that offshored, but I don't think the offshore experience is as good as automating it. So plenty of opportunities out there to save on that. Saving on how we do authorization and eligibility. Saving on the way that coding is delivered and qualified and whatnot. There's many different ways that you can save on your expense line, but you have to think differently. You have to be willing to challenge the norm, and you have to be willing to create a patient experience that fundamentally some patients will disagree with. Some clinicians, doctors will disagree with. Some receptionists will disagree with. What if our waiting room was no longer? What if we were pulling people from a community cafe to our facility? What if we had a different check-in system? We have robots driving cars. If we can have a Waymo, we should be able to have the receptionist become a Jetson. I'll say it that way. And I think we can qualify our communication in different ways to create more buy-in, relationship building, and outcomes. Okay, so ROI. Like I said, I'm not seeing the ROI on my receptionist. Now, we need to evaluate every single area of ROI. ROI on your facility, ROI on each therapist, ROI on the Amazon orders, ROI. You know, it's amazing that when I go into a practice that doesn't have a budget, the quantifiable amount they spend on Amazon would blow your mind. And I'm like, well, did we need this? Well, I just figured it would be helpful. We have no budget for that. Like, we have to define each expense, because when I go in and I say, hey, if I shaved your Amazon expense by 50%, would your employees be happy if I gave them an extra $1 an hour? Oh, yeah. I mean, that's quantifiably, some of these Amazon orders are that like outrageous. So we have to put everything in perspective to every stakeholder in our company, our employers, our leaders, our patients, everything. Every dollar has to go somewhere. And the more that you want that dollar to be, the more you have to steal it from a different pot. Where are we stealing it from? I want you to measure our expense analytics in different time comparisons. I want you to do quarterly analytics. So every quarter, I want you to measure it quarter over quarter, both Q1 over Q1, but Q1 over Q4. So right now in 2025, you can already be measuring both prior quarters of 2025 or Q2 of 2025 over Q2 of 2024 over Q2 of 2023. Look at a 3-year trajectory of that exact period of time over period of time. I think it's important that you understand that there is seasonal, but then there's also trailing. So looking at holiday season over holiday season is important. When someone says to me, hey, Brandon, our numbers crashed because of Christmas, I go, we had a 30% reduction of the prior Christmas, so you can't just blame Christmas. Something happened. Let's find that result. So we're looking at quarterly analytics, annual analytics, trailing analytics, and month-over-month analytics. July over June, July over July, all those different things. So again, looking at it, and I use this picture in my business algorithm episode. I want you to look at a Rubik's Cube, and I want you to see that every color is an expense. And you have to line all the colors up so that all the expenses are aligned appropriately for revenue generating optimization. Plain and simple. So I've got 5 KPIs. And these 5 KPIs coexist together. And they are ultimately what will help define your business algorithm. If you listen to that episode, this correlates, and I kind of mentioned it. But I'm going to break it down so that we understand. This is essentially revenue to expense ratio or expense to revenue ratio. So the first thing we have to do, we have to define our net profit minimum, our net profit target, our net profit reach. I'm going to say that again. Defining your net profit minimum. That is the minimum sustainable net profit for us to be in business. Our net profit target, where we want to be, and our net profit reach. Our net profit reach is something that is just industry-wise, business algorithm-wise, it's rare. Less than 10% reach that level. That's a reach. So for the sake of our algorithm today, because we have so many different types of practices that are tuning in, I'm going to go with bare minimum. I cannot justify a bare minimum less than 15%. You must have a 15% net profit margin at every time. And I want to be clear, because you're going to say this to me, what about my salary? How does that factor into it? Your salary needs to be calculated based on fair and reasonable expense for the functions that you play. And I just had this. My CPA reached out and said, I think you're underpaying yourself, Brandon. You got to pay yourself more. Okay, I'll pay myself more. Meaning that that salary has to be high enough or relevant enough. Now, if you work 2 days a week and pay yourself $300,000, that is not you're taking what I call as net profit from your wage. So then your net profit's going to look low. But if you're paying yourself $40,000 a year, that's not realistic either. So you have to find that middle ground. But you must have 15%. For the sake of this minimum target, I want you to look for a 20% goal net profit, and I want your reach to be 25. 15, 20, 25 as just a baseline for this episode. You may be like, oh, Brandon, I got 50%. Well, great. You've got a business algorithm that works for that. That is an outlier in most private practice industries, but I've seen it done. The next thing, so we named it 15% minimum. Now we're going to name the maximum affordability for our total people expense. Our maximum total people expense is 60%. That is everyone. That's admin, doctors. That's all their benefits. That's everything you can think of. It cannot exceed 60%, people. There's not enough margin in this game if you're paying over 60% to your total people expense. Our total facility expense is not to exceed 10%, with 4% being our goal. Again, I'm going to say it again. Total facility expense must be 10% or less with a goal of 4%. Now, I'm going to throw this out there. 2 and 3, I'll let you put that together if you want. So you can feed Peter to pay Paul if you want. So if you have a low TPE and you want a fancier space, you can give it to the facility expense. Or if you have a low facility expense and want to feed it to the people expense, you can do that. So together, 2 and 3, total people expense and total facility expense never, ever, ever, ever exceed 70% with a goal of 64%. Okay? Now the last two, number 4 and number 5. Are you ready for this? This is a breakout of your total people expense. So from your total people expense, I'm now looking at what is the percentage of admin that takes from revenue? What is the percentage of practitioner that takes from revenue? So I am putting your admin TPE as 10 to 15% of the revenue that your practice generates. Your practitioner is 45 to 50%. So obviously 45% practitioner, 15% admin, that's 60%. 50% practitioner, 10% admin, that's 60%. You get the game, but I just wanted to deconstruct it so that you could see how we deconstruct the total people expense and how we frame it in ratio to our profit and our revenue to expense ratio. So I kind of touched on this a little, but I'm going to bring it up again. There is a difference between net profit and owner's benefit. Net profit is the amount of money left over after all expenses have been deducted from total revenue. It is a key indicator of a company's profitability. The net profit is basically total revenue minus total expenses, including operating expenses, taxes, interest, depreciation, the whole bit. Purpose: it is used to measure the overall financial performance of the business and is often reported in financial statements. Scope reflects the financial health and efficiency of your business. That's why we look at net profit. However, owner's benefit, this can be seen as the owner's benefit, which can include owner's discretionary earnings. So owner's benefit, also known as owner's discretionary earnings, represents the total financial benefit that the owner derives from the business. This includes net profit plus any perks, benefits, and discretionary expenses. The calculation for this is owner's benefit is equal to net profit plus owner's salary plus discretionary expenses plus non-reoccurring expenses that are not required for the business, plus any other perks like personal travel expenses, car, gas, etc. for you. So again, you have to consult with your CPA. Some owners take different benefits, like, hey, I'm going to go take this business trip and I can write this off as a business expense and I'm doing business, but there's pleasure, whatever. Again, things are tightening up in those tax ramifications now, but bottom line is there may be expenses that you put through the business that the business pays for that would be considered part of the owner's benefit. Purpose. It's used mainly in valuing small businesses as it reflects to the total economic benefit to the owner, not just the net profit. So when I am looking at this is when I'm coming up with your valuation. We're going to say, what is this business? If someone's walking into this business, what is the total benefit that that new owner is going to gain as a result of now there's no longer the owner's car or the this or the that, all those different things. Scope. This provides a more comprehensive view of what the owner actually gains from the business, which is really important to a potential buyer. When I buy a business and they're like, hey, it's a $200,000, we'll call it net benefit to the company. But then I see the owner is working for no salary. Well, then I'm like, okay, so that's all I'm getting is a $200,000 job out of this. So you got to look at all those factors. What is the net benefit to someone walking in? What does that look like? And what will an owner gain if they buy your business? And at the end of the day, you can have a $5 million company that makes nothing. And I'll be honest with you, most people would walk away from that unless they see that they can make something from it. So you got to look at sometimes a $500,000 net profit on a $2 million business is better than a $5 million business that does, call it 200K. You get my point. What's left? What's that meat on the bone? So key differences: net profit focuses solely on the company's financial performance, while owner's benefit considers the total economic benefit to the owner. We use net profit for standard reporting, whereas owner's benefit is normally business valuations. Private practices use it when they're selling their business, etc. Components: net profit includes only business-related revenue and expenses, while owner's benefit is all additional perks and discretionary expenses. So in breaking down your profit and loss statement, we talked about how to craft your expense analysis, how to understand the revenue in ratio to expenses, and the difference between net profit and owner's benefit. So I want to leave you with a statistic for this episode, and it comes from SCORE. And it says companies that review their profit and loss statements monthly are 50% more likely to improve profitability year over year. Interesting. I'll say it one more time. Basically, what they're saying is if you review your profit and loss statement monthly, you are 50% more likely to improve profitability year over year. That's a pretty incredible statistic. So guess what? Throw out my quarterly advice, go to monthly, and show me that you will be 50% more likely, more profitable in 2025 than 2024 or any year. And as we wrap up this episode, our quote for today, which is unknown, anonymous: behind every successful business is a well-managed profit and loss statement. Again, behind every successful business is a well-managed profit and loss statement. So I want you to get out that profit and loss statement. I want you to build your expense breakdown. I want you to go line by line, and I want you to call me if you get stuck. There are plenty of people that can help you. It is ignorance that gets us lost in the desert. So let's find our data. Let's find our trajectory. Together, we can thrive, not just survive. If you like this episode, please like it, comment, rate us, share us, watch us on YouTube, or listen to us anywhere where podcasts are streamed. Thanks again for being part of the Private Practice Survival Guide podcast. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you love this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.